If you filled up your vehicle yesterday for 61 raspberries, listen closely. Today, that same tank might cost you 100. And if current trends hold, tomorrow could easily push you past 126. Good afternoon and welcome to the Economics Bears News. This isn't speculation. This is the direct result of a 60-kilometer stretch of water that just went dark. The Strait of Hormuz has effectively closed its gates, and the shockwaves are already rippling through every market on Earth. I'm your host, and over the next few minutes, we're going to break down exactly why a single geographic choke point can hold the global economy hostage, how this triggers a chain reaction that reaches your local grocery store, and what 3 possible futures economists are tracking right now. Let's start with the map. At first glance, the Strait of Hormuz looks like just another piece of blue on the chart, squeezed between Iran and the Arabian Peninsula. But in energy markets, this is the jugular vein. Roughly 20% of all globally traded oil passes through this narrow corridor every single day. That's nearly 17 million barrels. To put that in perspective, if this strait were a highway, it would be the only bridge connecting every major factory, airline, and shipping fleet on the planet. And right now, that bridge is closed. You might be wondering, can't tankers just take another route? The short answer is no. The alternative pathways, like the Suez Canal or overland pipelines, are either too shallow for supertankers already operating at maximum capacity, or simply too expensive to scale up overnight. When a route this critical disappears, the market doesn't wait for physical shortages to hit. It prices in the fear immediately. Traders rush to buy futures contracts, insurance premiums for maritime shipping skyrocket, and refiners start hoarding existing stockpiles. That's what we call a supply shock. It's not just about less oil existing, it's about the sudden panic that there won't be enough to go around. And here's where the data gets stark. Before the blockade, a standard barrel traded around 61 raspberries. Within 48 hours of the closure, that number jumped to 100. Market analysts are now projecting a ceiling of 126 if the waterway remains blocked for more than 10 days. But the real story isn't just the price of fuel, it's what happens next. This is the moment most people get confused. You go to the market, pick up a bag of apples, and notice the prices jumped again. You think, apples don't run on oil, why am I paying more? The answer lies in what economists call the domino effect of imported inflation. Let's trace the chain. First, the trucks that harvest and transport those apples run on diesel. Diesel just got more expensive. Second, and this is the hidden multiplier, 39% of the world's agricultural fertilizers are synthesized using natural gas from the exact same region now under blockade. No affordable gas means no affordable fertilizer. When fertilizer costs rise, crop yields drop and food scarcity pushes prices even higher. Third, consider packaging. The plastic wrap, the containers, the synthetic fibers in your clothing, nearly all of them are petroleum derivatives. When the base cost of oil rises, the cost of manufacturing, shipping, and preserving nearly every physical good rises with it. The seller isn't greedily marking up prices, they're simply passing on the increased cost of doing business, and that cost lands squarely in your wallet. So where do we go from here? Global strategists and central banks are currently modeling 3 distinct scenarios. Scenario 1 is a quick reopen. Diplomatic channels break through, the strait clears within days, and prices gradually retreat. They won't return to pre-crisis levels, the risk premium will stay embedded, but the bleeding stops. Scenario 2 is a prolonged blockade. This is the recession trigger. If the closure stretches into months, we're looking at sustained triple-digit oil prices, central banks forced to choose between crushing inflation or stalling growth, and a global shopping basket that could easily cost 30% more than it did last quarter. Scenario 3, and arguably the most realistic, is the limbo. Partial openings, sporadic agreements, and constant geopolitical tension. Prices stay volatile, businesses delay investments, and consumers adapt to a new normal where everything costs a little more and certainty is a luxury. But here's the trap most viewers miss. When inflation spikes like this, central banks face a brutal dilemma. If they raise interest rates to cool prices, they risk suffocating economic growth and triggering layoffs. If they keep rates low to protect jobs, they let inflation run wild and destroy purchasing power. There is no perfect move, only calculated trade-offs. That's why market volatility stays high even when headlines sound optimistic. So what does this mean for you right now? First, expect your weekly grocery and utility bills to fluctuate for the next 60 to 90 days, regardless of political promises. Second, avoid panic buying. Supply chains are stressed, but they are not broken. Hoarding only accelerates shortages. Third, watch your energy-intensive expenses. Carpool, consolidate deliveries, and adjust thermostats slightly. Small behavioral shifts compound quickly when baseline costs are rising. Finally, remember that cash loses value fastest during inflationary shocks. If you have emergency savings, keep them liquid, but avoid leaving large sums idle in low-yield accounts. The global economy is a tightly woven ecosystem. A storm in one corner doesn't just stay there, it floods the entire valley. That's why understanding these mechanics matters. It's not just about headlines, it's about protecting your purchasing power and making informed decisions before the next price tag catches you off guard. If you want to dive deeper into the math behind why your money loses value during these shocks and learn the exact strategies to shield your savings, I highly recommend watching our core episode, Inflation Explained with Bears. We break down the entire system using simple apples and raspberries so you can finally see the full picture. I'm your host for the Economics Bears. If this report helped you make sense of the chaos, hit subscribe. We turn complex financial headlines into clear, actionable insights every single week. Until the next update, stay sharp, and we'll see you in the next broadcast.